Hi, my name is Brian Nielsen, and I'm the Executive Director of the Blockchain Academy. And we're going to be doing something a little bit different with these videos. We're going to be giving you a set of 4 videos that is going to show you and introduce you to the world of cryptocurrency. Now, it's important for you to kind of step back, relax, because we're going to be introducing a lot of things to you rather quickly. So this is video 1 of the introduction to cryptocurrencies. So the very first thing that we're going to talk about, of course, is what is money? I mean, money is a kind of a fungible thing. We're not quite sure what it is, so let's take a moment to define exactly what it is. So money is, first of all, a medium of exchange. It's the ability for you to actually give something of value, money, in exchange for something of value. Say clothing, records, music, boots, tennis shoes, whatever it is you want to buy, houses. Doesn't really make any difference what it is, but it's a medium for exchange. The second thing is it's a unit of account, and that means that you can actually measure it. So if I say that I have $1,000 or $100, and someone is telling me, oh, you can buy this for a particular price, I know if I have the right amount. So it's important to understand that it's also a unit of account. The third thing that it is very important for money to be is it has to be a store of value. Now, things like gold are a store of value, silver are a store of value, paintings, wine can be a store of value. But the issue at hand is that for it to be money, it needs to be really these 3. There are other properties that are important to have in money, and the first one, of course, is that it has to be durable. It has to be something that people are going to want to accept over time. It has to be portable, meaning that you have to carry it. But that's not always true. There are certain situations, and we're going to talk about them, where the value of money was not exactly portable. But it needs to be uniform. It's going to be uniform in terms of presentation. It's going to be uniform in terms of how it's accepted. It needs to be kind of a limited supply. That's a little bit more difficult to do with fiat currencies simply because most central banks have the ability to print more. The next thing is of course, it has to be acceptable. So the more places that it's acceptable, the better its use as a medium of exchange is higher. So currencies are this paper denomination, the ability to actually attribute value to these pieces of paper in such a way that it allows for us to be able to deliver it to somebody, carry large amounts, or even have denominations in larger amounts that represent then an increased unit of account. It has to be divisible. So in most currencies, they're divisible by 10. There has been in the past where the things were base 12. So you looked at the pound originally. A pence was really a 12th of a pound. So you have these kinds of things where there was unusual, but over time and in today's modern society, all currencies are in base 10, which means that they're all divisible by that amount. The last thing is it has to be fungible, meaning that it has to be acceptable in such a way that, if I took currency, say in a euro standpoint, that I have the ability to actually go to another place and convert it into a currency that I can then use or want. The reason why I say it's not always portable is, and we're going to talk about this, is it's the island of Yap in the Pacific. And they created a unique type of currency, and that is these very large stones. So the stones had value. Well, as you can see by the size of these stones, the smaller ones, you can actually probably move around. So if you could pick one up with a stick in the middle and carry it someplace, you'd be able to actually say, I'm bringing this store of value, this is basically called stone money, to you, and I can buy whatever it is I need. So if I need 3 cows, I can do that. But the very large one here that you're looking at, that one is just too massive. So what they in essence did is they attributed value and the ownership of that to different people, but they never moved the stones. The only exception would be is if one of the stones rolled into the ocean and then became under the sea. This is simply because it was not verifiable as to whether it still existed. But as long as they could be seen, these stones of money were quite interesting in terms of what you could use and buy with it. And it was also a great store of value. There are different kinds of money, so let's kind of briefly go over them. So the very first one, of course, is commodity. So we're looking at things like gold and silver, and copper, the metals, platinum. These are important things that we can have that have a store of value, and they also have a medium of exchange. You can also look, though, at things like rice or wampum or salt. Peppercorns, again, large stones, decorative bells were currency, shells, and of course, there's always the prison monetary issues of alcohol, cigarettes, cannabis, candy, etc. These are all type of commodity-based stores of value that you can use for money. You also, though, have representative aspects of money. And so those are things like coins and paper money and other physical tokens, such as a certificate, like a stock certificate. You also have the issue that it has to be reliably exchanged for a fixed quantity, such as gold or silver. So if you have gold and you know what the price of an ounce of gold is, you should be able to do that. We're also looking at, though, is fiat currencies. Now, something that is interesting about fiat currencies is that they're issued by governments. That's why they're fiat. And the governments then therefore declare that they're legal tender. And the reason why they can do that is they can mandate that any taxes that are paid to them be paid in this fiat currency, and that's where the power truly is. There's also times and situations where it's unlawful to accept for certain types of fiat currencies. Certain currencies become illegal due to, say, terroristic activities of a particular nation, and therefore what happens is that fiat currency is basically banned. And as a result of that, you can find yourself in an unlawful possession of currency that might have value elsewhere, but wherever your geographic location is today, might not have any value. You think about paper currency. This was originally something that was invented in China and part of the Silk Road, and it was simply a method to facilitate the transfer of value. I mean, if you had to carry a specific weight of gold with you over long distances, there was risk of theft. Just the logistics of carrying something that was so heavy became problematic. So what in essence happened was these merchants set up these exchanges where you would go and deposit your gold, and you would be given a certificate, a piece of paper that would in essence say, you have this on deposit, and as a result what you can do is you then can go to these other people that you're buying in as part of your exchange and use that paper as a way of transferring value that you've deposited with these exchanges. You could, of course, have things like diamonds or rubies or precious stones. That, again, though, becomes problematic because they're not easily divisible. And not everyone wants to value them exactly the same thing. Part of the whole issue is that by having these things like paper currency and paper banknotes, it allowed for people to also, from the merchant standpoint, to issue things like receipts. The ability to say, I've received this in exchange for that amount. And that became very important. There are other kinds of money that we're going to be looking at, and some of them we refer to them as digital or electronic. Now, these are distinct from the physical banknotes and coins, and really what makes them interesting is that they exhibit properties similar to physical currencies, but they allow for instantaneous transactions across borders. Once it becomes electronic or digital, what I can do is then transfer it to you, and you can receive that. While we're looking at this, you have to say to yourself, if you have these digital currencies, where do they really work? Well, they're really adept to specific communities. You can also use these digital or electronic things within game environments, where the store of value is not necessarily coins itself, but it could be swords, or it could be shielding, it could be an ostrich as a means of transportation. But in essence, what it allows for it to happen is that there is an exchange and a recorded, electronically recorded exchange between people for a digital currency or a digital valuation of the money for something in exchange for it. And of course, this is all centrally controlled, and for the most part, that's the way it is. But what we're going to try to do is to understand how could they be decentralized. Now, if you and I have the ability to have money and we can make exchanges, there could be 10 people in this room, and I could individually exchange money with all 10 people. and the other 9 would not be party to the exchange I'm making with the one that I'm doing the current exchange with. So as a result of that, it's not necessarily centralized. I don't have to go to a central person and then they make the exchange. When we're using currencies like that, that's the fungible aspect, is the ability to actually go out there and exchange value in such a fashion. We have this new idea of what cryptocurrencies are, and they're very, very interesting in the sense that they're new, they're large in terms of the size of the markets, and so let's take a moment and really try to understand more about these cryptocurrencies. So the very first thing that we're going to look at here, and this is a very interesting chart, and that basically shows the past year, the total value of the crypto market. Now currently, it's about $480 billion, but it peaked up above $800 billion in December. This is a very vibrant, very large market. If you looked at it as in terms of the amount that's exchanged and the total value of the currencies out there, it ranks, cryptocurrencies as a whole rank like 4th or 5th in terms of size of a monetary means of exchange. Now, one of the things I wanted to point out here is that as recently as a year ago, what you saw was the value being really quite low, only about $150 billion. And of course, over the course of 2017, you saw it peak at almost a little over 800 billion in December. And now again, it's 469 as of today. So, and in essence, what we're seeing here on this chart here is the distribution of the currencies, of basically the top 10 or 15 currencies as a percentage of the whole. There's really about almost 2,000 cryptocurrencies. Most of them have little or no value in terms of the overall market, but they still are out there. They might have $1 million or $2 million or even $5 million valuations. But the behemoths, of course, would be like Bitcoin with $165 billion value, Ethereum with $91 billion, you have Bitcoin Cash with $23 billion, Ripple, now that was a great excitement that happened. It's currently at 44 billion. These are really multi-billion dollar markets. The reason why I'm kind of showing you this is because cryptos are kind of volatile. And so the pricing on them is important for you to be kind of tracking, simply because when you're starting to understand and thinking about wanting to trade cryptocurrencies, you really have to slow down and say, what are the valuations? Because this is going to be an important part of any decision you make in terms of what you're trying to do in terms of trading. What makes cryptocurrencies different is that they're really a digital asset, and they're designed to work with various exchanges using a concept called cryptography. And cryptography we're going to talk about in a second, but it's the method to ensure that what we're trading and what's being recorded on the blockchain is actually recorded correctly. So it's important for us to understand that cryptocurrencies are kind of a subset of all these digital currencies, and there are subsets of that even in the form of what we call altcoins. Now, a digital asset, this is important to understand. Anything that can be digitalized can be a digital asset. Therefore, it could be traded as a method of value. So some of the things that are digital assets can be things like intellectual property, and that could be like, of course, video, audio, film, photography. It could be books. It could be patents. It could be trademarks. Anything that's intellectually developed and therefore attributed to having a particular value can be part of a digital asset. But you can also look at things like stocks and bonds and currencies, of course. You have things like all the derivatives. These are all digital assets that can actually be attributed, have a specific value, and be able to be traded. You also have things, though, of records. So this is important to think about. What is a digital asset? Well, your birth certificate could be a digital asset. Your ownership of your car could be a digital asset. You could be looking about and saying, well, what about my identity? Well, in essence, that's a digital asset. You may not be able to exchange it, but it at least is specific to you or a particular form of asset, you in this particular case. You can have, though, digital assets in terms of like education. So if you have a diploma from a university, that it can be a digital asset. You may not be able to exchange it, but it can at least be verified independently. And of course, things like building permits or any type of permit, hunting permits, anything that the government might be issuing to give authority or authorization to participate in something, those are digital assets. To understand what kind of like encryption is, it really is a method to scramble data. But in essence, what happens is it is created and it's very, very difficult to actually unscramble that, to guess it. But one of the things it does is it allows for, once a cryptography is used, to verify that it's accurate through the solution. So figuring the solution out is very hard. Verifying the solution is very, very easy. But you can actually create even more complexity with encryption by introducing things like fingerprints or iris scans, or even the gait of your walk. These are all unique to all individuals, and they can be used as a validation and verification in conjunction with encryption to make it even more and more difficult or more secure method of encryption. But you have to understand that it's theoretically possible to actually break these encryptions. What happens when computing technology leaves its current state and enters the quantum state? Well, a quantum computer would be able to actually solve a lot of things very, very quickly. The beautiful thing, though, about encryption and cryptography is we already have, we don't have quantum computers yet, but we already have quantum cryptography. So it would even prevent them from finding a solution to actually then fraudulently change what you're going to be experiencing or what you're trying to encrypt. The other thing is that we broke the keys up for all these cryptographies to create a public and a private key. So the public key is the one that you share with people, and the private keys is the one you use to validate everything. So this whole idea of creating this encryption and creating a secure environment where people could actually validate ownership and trading is very, very important. Now, what's unique about cryptocurrencies is that it's evolved from what we normally see. So if you deal with your local bank, everything is centralized in that bank. So they have this big central computer where they're actually managing the ledger of all the transactions that are occurring within the bank. And then every bank has their own centralized version of all these exchanges. But what is unique about blockchain and cryptocurrencies is that we've moved away from this centralized environment and now moved to a decentralized, or even better yet, a distributed environment. So the Bitcoin environment is really a distributed environment. It allows for people to participate in what they refer to as mining. And the reason why they refer to it as mining is because Bitcoin was originally called kind of like a digital gold. And so how do you get gold? You mine for gold. So the whole concept of what a distributed miner is doing is they're mining for the gold, the Bitcoin. What's, though, unique about all of this is that cryptocurrencies would not necessarily exist, and we're going to be talking about some of them that existed in, I don't want to say a prior life, but prior to actually Bitcoin's paper being issued. So the thing that Bitcoin and Satoshi Nakamoto, that's the developer or the person who is attributed to being the developer of the Bitcoin protocol, created this concept of that's called proof of work. And really what it comes down to is it's a way to measure that people are participating in particular solving these cryptography elements of cryptocurrencies, as well as ensuring that what was happening was going to be secure. So you couldn't go back and change the ledger, so to speak. So one of the things that is very interesting is that it's a scheme that's known for asymmetry. And basically what that means is that it's difficult to solve, but easy to verify. But you're also looking at things like how to describe what it is. So people thought of it in a number of different ways, and one of the ways that they've thought about it is that it's a client puzzle, or it's a computing puzzle. And that means that the computers are actually trying to solve these puzzles so that they can actually validate a particular transaction and build a block. Now, this is kind of different in a large way from like what you experience when you go on and sign on various websites where there's a CAPTCHA token there, and that's usually a visual thing that is hard for a computer to actually solve. So you're going to have to go through a set of, say, 9 images, and you're going to have to choose the images that have a car in it. Well, that's very simple for you and I to do. It's very, very difficult for a computer to do, simply because there's not necessarily enough information to figure out that calculation. But things that can be digitalized are just about anything. It could be, say, a painting of John Wayne. It could be your rewards, whether it be your flight rewards or hotel rewards or even your rewards at Subway. It can be, you can monetize and digitize the value of a car, say like even with a zip car. I mean, that's a perfect example of how it can be used in terms of digitally allocating and creating these tokens. Of course, you have the RSA fob. A lot of banks require that you use that to actually access your account. You have things like music, medical records. You have home ownership or real estate, but that's not limited to just real estate. It's to anything that you could own. So it could be a car, a motorcycle, or a boat. It could be any of these things. But you can also use these digital tokens to gamble with. Now, you can use them at real live casinos, or you could be using them with these online gaming situations. So we're going to kind of go through briefly what the history is of cryptocurrencies. So in 1983, David Chaum published the Untraceable Electronic Mail Return Addresses and Digital Pseudonyms. In 1990, so 7 years later, he founded DigiCash, which is an electronic cash company in Amsterdam, which was to basically commercialize the ideas of his research. And in 1996, eGold was launched as a digital gold currency that was operated by Gold and Silver Reserve. Now, this basically allowed people to buy into the ownership of these metals, gold and silver, and then exchange them basically with other people or with other metals. The idea of it is that you would be able to instantly transfer the value of these things. So in 1997, we even have, again, this is on like a cryptocurrency, Coca-Cola introduced the idea of being able to use mobile payments at their vending machines. You'd be able to go up, send it a text through your phone, and it would then drop down the Coca-Cola product that you actually wanted. And in 1998, the thing that was most interesting was the DigiCash filed for bankruptcy, and part of that was that they couldn't solve one of the problems that existed up to that point, and that is the double spend. So you have, the idea was originally that you take a bunch of money and you now own this gold. Well, the problem with digital cash is that it didn't restrict people from selling the same piece of gold multiple times. And in the end, that failure of technology basically led them to bankruptcy. But at the same time, then we started to get into these new payment methods. So PayPal was first introduced and emerged. And the other issue was in 2005 is we started to see that criminal activity started to become very involved in these cryptocurrencies. So you had criminals who were using it to exchange value, to transfer across borders, to hide what they were actually collecting. You also saw in 2005 that the Liberty Reserve was founded, which it allowed fiat currencies to be traded for these Liberty dollars. And part of that was to enable fast electronic exchange of value. Now again, we had a problem with that, and that is that criminals started to use it simply because it was shielding itself from the US government and the ability to be monitored. So then we ended up with Q coins or QQ coins, which were a type of commodity-based digital currency. And they were so effective that in China they were said to have destabilized the Chinese yuan currency due to the speculation of that. 2006, eGold was actually processing more than $2 billion worth of spends a year. And that is also followed up then by, in 2008, in November of 2008, this Satoshi Nakamoto, he published his first Bitcoin paper. And in January the following year, January 9th, the following year, 2009, he actually introduced the first Genesis block of Bitcoin. But in 2009, you also saw that eGold was suspended due to these legal issues, due to criminal activity. What's next of interest is, and it caused a widespread use of cryptocurrencies, was at the time that in 2011, WikiLeaks used to accept payments and donations to support their activities through credit cards, MasterCard and Visa. MasterCard and Visa basically said, we're not liking this because the government has a lot of attention on WikiLeaks, and we really want to withdraw that. So and what you saw was they cut off this source of funding. Well, WikiLeaks turned around and said, you know what? Hey, we still need to be supported. Why don't you start paying us in Bitcoin? And so for these donations. So what was very interesting was back then, Bitcoin was worth dollars. I think it peaked at $35 in 2011. So you started to see that all of a sudden people were converting some of their currency to these cryptocurrencies so that they could actually donate to WikiLeaks. By 2012, what we saw is that over 1,000 merchants, including WordPress, were accepting Bitcoin. So companies like Overstock.com, Apple, you could buy Virgin Atlantic and Virgin Galactic space rides using cryptocurrencies. Couldn't take the space rides at that time, but you could at least pay for them with these cryptocurrencies. In 2013, though, what we saw was the U.S. Financial Crimes Enforcement Network basically started to issue guidelines regarding these virtual currencies. And they basically turned around and started classifying Bitcoin miners as money service businesses, especially if you've ever seen a Bitcoin ATM. Originally, people were putting these up in venues like gas stations and cafeterias or anything that was basically a 24-hour-a-day type business. And people were going in and exchanging money for these cryptocurrencies. And you saw a lot of use when the hackers would actually come in to create malware, and the only way you could decrypt it was to send them Bitcoin, and as a result, people had to go to these Bitcoin ATMs to do it. Well, the government basically turned in and said, wait a minute, these are really money service businesses, and so that requires a whole new level of licensing. And of course, Liberty Reserve was shut down by the U.S. prosecutors, basically because they were laundering money for these criminal behaviors. Now, of note is that there's a lot of people who've said the reason why we shouldn't have cryptocurrencies is because of the criminal activity. Well, a recent study that was done actually estimated that the amount of criminal activity as a percentage of the overall market of just Bitcoin is less than 0.1%. Also in 2013, what we saw was we really saw the first problem with cryptocurrencies, and that was what we referred to as the MtGox. What we found out was that MtGox was originally a trading card exchange for a game called Magic. And so you would be able to trade your cards through their exchange. And they stepped back and said, hey, you know what? These cryptocurrencies are really not any different than these other digital assets that we're going to be doing. So they actually started trading it. But the problem that happened with MtGox is that their exchange code is not secure like the blockchain code for Bitcoin or for any of these other cryptos. And as a result, they were hacked. And at the time, the amount of cryptos or Bitcoin that was stolen was equivalent to about $485 million. So a huge, huge amount. It collapsed them. And of course, part of that you can see here on the chart is the FBI seized 26,000 Bitcoins from the guy who managed Silk Road, which was out of California. And of course, what I was talking about was ATMs first being introduced. The ability to take money into a particular machine, insert it, and then you would then be given a code then that would allow you to actually receive the Bitcoin in exchange. Here we also see now another major retailer accepting Bitcoins. Baidu started accepting Bitcoins in 2013. And in 2014, basically you started now to see the use of Bitcoin accepted by a larger number, and even altcoins by a larger number of groups. So things like physical games or gambling or hospitality or travel on a much larger scale. There was a greater acceptance of these cryptocurrencies at that time. And of course, what I said a little bit before, MtGox filed for bankruptcy. They reported that 744,000 Bitcoins had been stolen. And again, that was about almost $500 million. But as I said, companies like Overstock, Dell, Microsoft, they all began accepting these new cryptocurrencies as payment for their products. The cryptocurrencies as we know them today, it all started with a 9-page paper called Bitcoin, a peer-to-peer electronic cash system that was published in 2008. And what's amazing is how far-reaching this particular document is. It created some interesting solutions for the math and the algorithms and the cryptography, the introduction of that proof of work that we talked about earlier, and it actually created a way to secure all the crypto transactions. It eliminated that double spend that all these digital gold and digital cash never could solve. So by having these things resolved and having a clearer method to actually manage these digital ledgers, Bitcoin was quite interesting because it also did the last thing, and that's the last point here, and that is it used miners to incentivize compliance with the rules. The way they did it was through this concept called consensus. So when a Bitcoin miner finds the solution, it's very easy for all the other miners to go through and provide and validate that solution. So if you have a rogue miner who comes up with an alternative solution, it's quickly then rejected. So we have this 51% consensus rule that means that everybody's going to remain in compliance and everyone is going to follow the rules for this particular transaction. And it also then preserves integrity and provides trust and transparency to using cryptocurrencies. We're taking the time to actually share with you and allow you to understand this new world of cryptocurrencies. And what we're going to be leading to in the subsequent videos is things like, should you own cryptocurrencies? Should you invest in them? Should you trade them? And what are some of the risks involved in doing that? We want to thank you for participating and watching this video on cryptocurrencies.